Welcome to the Principles Experience. This channel is designed to give you financial content in the areas of business, finance, and investing, while bringing you stories of the mindset of entrepreneurs and their tips on building a business. Sit back and learn on how you can develop your financial wisdom and create a blueprint for financial freedom. What's going on, world? Welcome to another episode of the Principles Podcast. My name is Kevin Jenkins. Thank you so much for tuning in again. This is the 9th episode, and what we're going to discuss today, what I'm going to discuss for you all today, is how you can maximize your retirement. And, I know from the previous episodes that I've done, I've talked about the importance of life insurance. That was episode 4. If you all haven't seen it, it's a great episode. It talks a lot about just ways of how you can structure a life insurance plan and what are the best options out there. But this episode is going to be an extended conversation from that episode. And I'm going to talk on how insurance can be used for retirement. But I'm also going to talk on later throughout this episode, I'm going to discuss how business owners can use SEP IRAs and simple IRA plans. Which is SEP IRA is a Simplified Employee Pension Plan, and then with a simple plan, it's a savings incentive match plan for employees. So I'm going to talk on how business owners, how they can structure their retirement plans for not only themselves, but for their employees. And I think that I'm going to also explain the importance of annuities. When we talk about insurance products, you have to talk about annuities. And I think that, annuities are great because they provide another steady stream of income, especially in your retirement days. And, I want to talk on how you can use annuities and put it a part of your financial plan, and explaining how they're distributed and what exactly are the different payout options. So let's go ahead and let's get into it. So what exactly is an annuity? An annuity is a financial product that pays a specific stream of payments to an individual. Is used mostly for individuals approaching retirement or retirees that are looking for a steady stream of income. Now, you're able to get an annuity at any financial institution or any investment company. They'll be willing to sell it to you. But my job is to make sure I explain to you thoroughly what annuities are and how they're structured, so you can have a better understanding of making educated financial decision when that time may come. So annuities, they provide a lifetime of income to the annuitant. What the annuitant is, they are the annuity holder or the one that's going to be receiving the benefit, similar to like a surviving spouse. And I'm going to talk on later in this episode exactly what is a great annuity product for a surviving spouse, for a married couple. I have a great explanation of a product that's available for married couples and just couples in general. So I'm going to explain on that briefly later throughout the podcast. Now, annuities are, the purpose of an annuity is to be able to address the risk of you outliving your assets. It addresses the longevity risk, which is the risk that you're going to outlive your savings, and having something in place that can still provide you income if you do go through your assets, which you definitely don't want to do. You want to be mindful of making sure that you're being diligent on saving and making sure you have enough to help you in retirement. But it's nothing wrong with making sure that you have annuities in place that can provide another stream of income. It's just more money that you can have in your retirement portfolio and how you can expand it. Now, there are 3 factors that affect the amount of an annuity benefit, and those are the principal, the interest, and the length of the payout period. When I was writing this down, the biggest thing that I thought about is when you have a mortgage. Now, if you have a mortgage, what are 3 things that affect your mortgage payment? The principal, the interest, and the length of the mortgage term, whether it's a 15-year fixed mortgage or a 30-year fixed. All of those factors are going to affect how much you pay on a monthly basis. And it's the same concept with an annuity. Now, you have 2 different periods with an annuity. You have the accumulation period and the annuitization period. Pretty much what the accumulation period is it's the period that you're paying into the annuity before they pay it out. So it's usually a period when someone is funded annuity before the insurance company decides, okay, this is when we're going to pay out the annuity to this individual. Now, the annuitization period is usually when someone funds an annuity before my corrections. An annuitization period, it can happen at any time, and it also can happen at any age, and it gives a lifetime of income payments to the annuitant. Now, once the payment cease, the contract is in an annuitization period. So simply, once you stop paying on the annuity and it's starting to be paid out to you, then you're now into the annuitization period. Now, when it comes to the annuitization period, keep in mind that with whether it's annuitization or accumulation, mainly with the annuitization, you have 5 payout options of the annuity. And the first one is straight life, life only, which there's no beneficiary. This is the first payout option that you can have with an annuity. And what it means is that when you annuitize an annuity, the payments are given to you as long as you live, but they're not given to a beneficiary. So once the payments are done, they're going to pay you an annuity in a straight life annuity policy for the remaining years of your life. But once you pass away, you can't pass anything down to a beneficiary. This one I really don't like too much, because whenever I'm thinking about financial planning, I'm thinking about ways of how I can build generational wealth and how I can pass my wealth down to individuals or beneficiaries. And I think with the straight life, you don't really have that option. So that one is pretty tough when you talk about having something to pass down. The second one is cash refund. I really love this one because with a cash refund, you have a beneficiary, but only for the principal that's left in the annuity at the time of the annuitant's death. So what pretty much that means is there's a beneficiary element with a cash refund, but they're only going to get, the beneficiary is only going to get an amount of whatever's left of the principal at the time of the annuitant's death. So for example, let's say you have a retiree that purchased a $120,000 annuity plan, and $80,000 of the annuity is given to the annuitant before they pass away. The beneficiary in this scenario, they're going to get $40,000 and a lump sum cash refund from the insurance company. And that's just a concrete example of how a cash refund annuity plan works. Now, this one is great because it gives you the flexibility of having the benefit of having money for the annuitant. The annuitant is having a stream of income, and then you also have money that you can give to a beneficiary that they can have money once you pass away. So the cash refund is an excellent annuity product. Now, the third one is an installment refund. Now, this has a beneficiary included, but income payments will end when the principal is exhausted, and that's usually the annuitant's life expectancy. So with an installment refund annuity, you do have the beneficiary attached, but the income payments are going to go away when that principal is exhausted. So if the principal on a policy for the annuitant is, let's say, 65 years old, the insurance company, they're going to structure the policy where when it gets to that point at 65, the principal is going to go away and the beneficiary is not going to be able to receive an amount on the annuity. So it's definitely good to make sure you do your research on that one. Now, the fourth one is life with period certain. This has a beneficiary only if the annuitant dies during a guaranteed period. Now, the beneficiary is only going to be paid based on the length of the period. If the annuitant dies after the guarantee period, then there won't be no payments after the annuitant dies. So I look at this one as if you have a life with period certain for, let's say, 5 years, if the annuitant was to die during that 5-year period, then the beneficiary is going to get a stream of income payments. But if it goes past the 5-year mark, they're not going to receive anything. So, this one I don't like too much, but I definitely think it's a great annuity product. If there's someone in your family that has a serious medical condition and they only have a certain amount of time that they're going to live, this is a great option to have where they can have some money in an annuity plan during their retirement ages, and then also the beneficiary can have money as well. Now, the final payout option, which is the one I would say is one of my favorites, is the joint and survivor. This one doesn't have a beneficiary, but the survivor is the annuitant. There isn't a beneficiary attached. So with this option, let's say you have a couple that purchase a joint and survivor annuity policy. If the husband were to die in this policy, then the wife is going to receive a certain amount of annuity payments in this policy. And it's great to what I mentioned earlier in this episode on surviving spouses, especially for all of my black men out there that are married, or any men in general. It's great to have this policy in place because it's great to pass something down to your significant other, and it gives you the flexibility of making sure that, if something were to happen to you, you can pass it down to your wife, or your husband, whichever scenario it is in your case. Now, I did want to mention how annuities are structured. Now, they're either structured as a fixed or a variable annuity. What fixed annuities are, they provide regular periodic payments to the annuitant. With variable annuities, the owner has a higher chance of receiving a bigger rate of return from the investment of the annuity. So the reason why there's a higher rate of return with a variable annuity is because a lot of times the investment fund of the annuity is being invested into the equity markets. So that's the reason why you have a higher rate of return rather than with a fixed annuity. It's just it's a guaranteed rate of return to the investor. The insurance company is controlling the investment, and they pretty much make the investments for you, and then you can receive the periodic payments from the annuity once you pay it out, rather than with the variable annuity. There is more risk there. So even though you can receive a higher rate of return, the risk is if the fund does poorly in the annuity, then that can lead to less stable cash flows and also smaller payments. So keep that in mind with a variable annuity. It's not so much that a variable annuity is risky, but you have to make sure that you do the research and make sure that you're making an educated financial decision and you understand what is being invested into. Now, with a variable annuity, there isn't a guaranteed rate of return because you control the investment, you are making the decisions, and then the insurance company is simply doing what you've asked and how you want that variable annuity to be invested. Now, keep in mind, with a fixed annuity, I did mention that there isn't no guaranteed rate of return. So no matter how good or bad the investment fund does or how the annuity performs, you're still going to get that guaranteed amount. The investor's still going to get that guaranteed amount of the annuity. So if you are a person that you don't want as much risk, a fixed annuity is a great option. But if you're looking at ways of how you want to control your investment and you want to be able to get a higher rate of return on your annuity investment, I would definitely look at a variable annuity. Now, I wanted to briefly explain the differences between annuities and life insurance. Now, life insurance is simply addressing the mortality risk, the risk of someone dying prematurely. That's the biggest reason why you would get a life insurance policy. With an annuities, the biggest difference is you're addressing the longevity risk. So kind of like I mentioned earlier in the podcast, is that you're addressing the risk of you outliving your assets or your savings. So annuities, they're great options for that. And they also allow you to be able to maximize your retirement and being able to add just another stream of income in your retirement days. We're not sure what the future is going to bring. So I'm looking at all of the different ways of how I can add multiple streams of income for myself and making sure I have more, for myself in retirement. And trust me, the financial decisions that you make while you're in your 20s or whatever age you may be in, the older person in the 50s, the 60s, the 70s, they're going to be very happy of the 20-year-old that made those decisions. The decisions that we make now are so prevalent on how our later years in retirement is going to be. So I wanted to transition this conversation, and I wanted to briefly talk on how business owners can be able to maximize their retirement for not only themselves, but for their employees. So you have what's called a SEP IRA. With a SEP IRA, it's a Simplified Employee Pension Plan. And this is great because a SEP IRA, it's pretty much a tax deferred retirement savings account, and a business owner, they can create it for the benefit of the employees or themselves. And this can be set up by proprietors. You can have a partnership. You can set it up. You can set it up with a corporation. Now, with a SEP, the employer makes the contribution for the employee on the employee's behalf, and these are tax deductible contributions. Like I mentioned, these plans are usually are created for small businesses that want to limit the amount of paperwork and the fiduciary responsibilities that come with establishing a qualified retirement plan, such as a 401k or a profit sharing plan. And some other advantages of a SEP IRA is you have low administrative costs, and the employer determines how much they want to contribute every year. So it's great if you want to have the flexibility of being able to decide how much you want to contribute every year. And it's not as much work involved with establishing a SEP than it is with setting up a 401k for your business. Now, initially, SEPs were created because they want to encourage retirement benefits among businesses that may not have an employer-sponsored plan set up. Now, the reason why I really love a SEP IRA is because it has the same investment options as a traditional IRA, but you can contribute to a much higher amount. For the year of 2020, the contributions for a SEP cannot exceed the lesser of 25% of the employee's compensation for the year, or $57,000. So you're able to contribute up to $57,000 tax deferred in a SEP IRA. With a traditional IRA, you're only able to contribute to $6,000. So there's a way bigger benefit on maximizing your contributions with a SEP if you're a business owner in comparison to a traditional IRA. So a SEP, it gives the business owner, the flexibility of saving more for retirement and allowing their employees to contribute to a retirement savings plan for themselves. Now, I wanted to lastly discuss what a simple IRA is. It's another tax deferred retirement account that business owners can use, but it's for businesses that have 100 or fewer employees. So that's very important to know. And I believe another requirement is you have to be 21 years old as well. Now, employers, they can decide to make a 2% retirement account contribution to all employees, or an optional matching contribution up to 3%. Now, a simple IRA is less costly to administer, similar to what I mentioned with a SEP, and it doesn't have as much paperwork as with a 401k. And the maximum contribution for a simple IRA is that it can be made by an employee of a salary reduction of $13,500. That's for the year 2020. And if you're 50 and older, you can make an additional catch-up contribution of $3,000 in a simple IRA. So SEP IRAs, simple IRAs, they're great. They're great tax deferred retirement accounts for business owners, especially if you're looking at ways to establish benefits for your employees. I know with talking, with entrepreneurs and people that work for successful companies, benefits is a big part of why an individual is going to work for a company. So if you have these things in place, it's going to give them more motivation to want to work for your firm or your corporation. And I think a lot of times with entrepreneurs, as we're building our businesses, we have expenses, we have salaries that we have to pay. We have our own savings that we may take out of our salary that we make with developing our business, but we don't really save more for retirement, or we don't understand the other options that are available to maximize even more for your retirement. I mean, a lot of people may know about traditional IRAs and Roth IRAs, but they don't know that you can use a SEP IRA if you're a business owner, and you can contribute up to $57,000 tax deferred. I mean, that's a great option. It's a great financial product to be aware of, and especially if you have your own business, it's one thing that you need to look into. So that pretty much wraps it up for this episode. I thank you all so much for watching, everyone on YouTube. If you all can follow my Instagram, it's Kevin Jenkins. I'm also on Facebook as well as Kevin Jenkins. And that's spelled, as far as the Instagram, that my Instagram is Kevin Jenkins. I'm also going to put the LinkTree in the show notes. It would be great if you all could also go listen to this episode on Apple Podcasts, Spotify. I'm on all platforms. You'll be able to listen to that as well. And I thank you all so much for your support. And I want to tell you thank you for tuning in, and I'll see you next time. Take care.